Welcome to the show. Today we'll talk about what happened on the market yesterday. We'll discuss the RBA's rate decision. We'll talk about what the tsunami of data that's coming out this week and continues to come out. We'll talk about what's happening with retail stocks, and we'll discuss whether you should fix your home loan or keep it on a variable rate. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. We've got no Peter Switzer here today, Paul.
No, Peter's on assignment, Marty.
Good.
I think it's called vocational experience or something like that.
Yeah. Having a bit of a bludgeon, I think we might call it.
We won't go quite that far, Marty, but you get the idea.
Very, very well deserved, I should say. So, lots of stuff happening at the moment in markets. Very interesting week. Big day yesterday. Somewhat surprising considering there wasn't much of a lead coming from anywhere, and the market's up 2%.
Came out of the blue yesterday, almost 100 points on the S&P ASX 200. Banks really leading the way in Telstra. Look, hooray, I think, because the market has been pretty ordinary.
Start of the Santa Claus rally?
Yeah, look, possibly. Maybe it's December. I think there's something about end of month, people needing to get positions. Maybe some of the shorts have got to close as we get into that sort of season when things wind down. Possibly start of a bit of a Santa Claus rally, but yeah, really impressive movement in our market yesterday.
And the miners didn't do too badly either.
Yeah, BHP, look, bounced back about 3.5%, but look, with commodity prices where they are, there's no quick recovery in sight in those stocks just yet. They've perhaps been oversold a touch, but for long-term investors, still good buying, but just need to be patient. Iron ore prices touching $40. Look, who knows just how far further that's got to go.
Now, the RBA came out yesterday and surprised no one by keeping the official cash rate on hold at 2%.
Surprised absolutely nobody. I think there was unanimity that it was going to stay at 2%.
7 months they've been on hold at 2% now.
Look, I'll go with the 7 months, Marty. I'm not counting, but I think the interesting thing about yesterday's statement was, look, they still left open the door for a rate decrease, should they need to.
Based on the inflation outlook?
Based on the inflation outlook. Did actually, again, fairly positive about growth, which of course we've got today. Some figures there, but they're still reasonably upbeat about how the economy is travelling. So
you've got to love the way the RBA words their statements, don't they? They're the masters at hedging their bets. I think one of the things they talked about would be there'd be a moderate expansion in economic growth despite the decline in mining. They talked about the fact that there's an expectation that the improvement in the economy could firm, good wording, but the inflation outlook still left open the possibility of further rate cuts.
Look, there's a whole career opportunity for someone who can write these statements.
How long would it take them to write this sort of stuff? There's a lot. Must be a lawyer, I'm sure.
I'm sure that someone goes through every single word, pulls out last month's statement. What did we say last month? What did we say the month before?
Yeah.
I'm not sure it's a lawyer, but I think it's a real profession for someone. You got a kid out there who's
Craig James sent that through yesterday in one of his reports. He looked at November and December and basically put them next to each other, and there were very few differences.
Well, that's what you do. I mean, that's what we all do. We look at it. It's a profession. So being a script writer for the is a script writer?
Something like that.
Something like that.
Next topic. Okay, there's been a tsunami of economic data coming out this week. Probably the most important numbers are about to come out now. We've got GDP today. Paul, what are you expecting?
Well, I'm probably with everyone else in GDP, somewhere between 0.7 and 0.8%. It'll be at 11:30. Look, that's up compared. The last quarter was only 0.2, so we'll get a pickup in the annual rate to about 2.3, 2.4. Look, I think the question, there's so much statistical error in these numbers, you can't put too much in it. It's really about the trend basis. But if it's not up on last quarter, substantially up, people were disappointed.
The rest of the data's been pretty good as well coming up. Building approvals, PMIs in Australia, not great in the US, okay in China, better than expected.
Look, the rest of the data's okay. I mean, I think also yesterday's property prices, I mean, that was good to see a bit of a cooling in the market. I'm sorry if you've been trying to sell, but that's just the way it is.
And the RBA were happy about that in their statement.
The RBA were happy about that. I was happy about that because I wrote about that in Switzer Daily more than 12 weeks ago. I said the spring market was going to be a cool market.
Yeah, the clearance rate was in the 50s again, wasn't it?
Clearance rate. So Sydney was down 1.4 in houses. Melbourne also had a drop. So look, this has to happen. The property market went too far. What people forget about property is it's not an isolated asset class. So you can't have the property market going up 20% and the share market falling by 10%. It doesn't work that way. Eventually, the markets come together again because of yields and rents and just value. And that's exactly why one of the reasons why the property market needed to cool a little bit, because the stock market had come off. And now we've seen that sort of balance being achieved. So I think we're not seeing a collapse, but we're going to get a bit of equilibrium. Yeah.
Now, big piece of data coming out on Friday internationally. Non-farm payrolls may play a part in what the Fed decides to do, do you think? Or do you think the Fed are basically locked and loaded?
I think if it's locked and loaded, I think they're locked and loaded, unless it's sort of way off the 200,000 expectations, so somewhere back towards 100,000. I think the market's still going for about 200,000 for November, unless it's so far away and there's something so unexpected. The rate increase on the 15th of December is locked and loaded.
Yep. Moving on, next topic. Stocks in focus. We're going to talk retail. Dick Smith has copped an absolute shellacking over the past week. I think it's down about 70%. Doing it very, very tough. Talk today of them do a massive fire sale to try and get themselves out of this trouble or just even stay above water. Jerry Harvey came out slamming it. Paul, your thoughts on the consumer discretionary space now? Their settings look pretty appropriate for some improvement in that space. We've got low oil prices, low interest rates. What are your thoughts?
I think I think the setting's okay. The actual part of the market, if you just put Dick Smith to one side, hasn't done too bad this year. I mean, JB Hi-Fi's done well. It's up about 15%, and Harvey Norman has also done all right.
Is Myer up 32%?
Well, it is, but off a very low base. So Myer, of course, they had a retirement offer and, of course, got slammed. But look, by and large, the sector, at least in the leading companies, is doing okay. So I think they're in tune for a better Christmas period than people expect, but time will tell. I think it's horses for courses. I don't know what's gone on with Dick Smith. I don't know how a retailer can actually stuff up its inventory. All right, that's what retailing is about.
A retailer that big too.
That big, and then needing to get experts in to come and tell her how to manage inventory. It doesn't make sense to me. So I think the problem with Dick Smith a little bit is it's lost its way in the sense that people don't know what it stands for. It's not really sort of the JB Hi-Fi place where you go for the music or the big flat screen TVs or whatever it is. Dick Smith is something else, and people are a bit confused. So I think the trouble with retailing, you've got to pick the retailer. I think there's value to be found in names like JB Hi-Fi and a couple of others.
The challenge with Dick Smith too is the sorts of product lines that they sell means that they're a price taker all the time, aren't they?
Look, I think so. I think the good ones will do well. And yesterday, JB Hi-Fi got impacted a little bit because of what's going on at Dick Smith. This big sale on the weekend, 70% off, which Jerry Harvey slammed this morning.
Yeah.
They'll maybe have an impact on their sales. But look, his comment was no one wants to buy the stuff they've got.
Crook stock, I think he called it.
Crook
stock. So
if you have 70% off, 80% off, who knows? So
I'm sure there'll be some buyers.
There'll be some buyers. Look, maybe there's a bit of value to be found, but I stick with the quality names in that sector.
Yeah. Moving on, finance tip with what's happening in interest rates at the moment. Reserve Bank looks like they're maintaining their bias towards easing, but they're probably going to stay on hold for quite a while. Question asked, but maybe the next move could be up. So that always brings a question as to whether or not you should fix with interest rates at historic lows. Paul, your thoughts on fixed versus variable interest rates?
Look, I like fixing mainly for budget certainty. Now, I've been saying fix for the last 3 years about half, and people will look back and say you've been wrong because interest rates have kept on coming down. And I think that's the experience of many borrowers. You go and I talk to my mates over coffee, those who fix or haven't, and anyone who says they're fixed says they've got it wrong.
You're taking the interest rate risk when you fix, aren't you?
Well, you are. You have to take the interest rate risk, but conversely, you're locking in certainty. And I think there's a big premium to be paid for certainty. You can budget for it, you can plan for it, all those good things. At the moment, look, I still like the idea of fixing because who knows what's going to happen tomorrow. These rates we know are historically low. We know the Reserve Bank keeps telling us they are sort of almost at like GFC type levels, emergency type levels, but I don't think interest rates in Australia are going up in the short term. So
when will lenders actually start? So if it looks like a rate rise, the bias is changing towards an expansionary bias. They're going to start increasing rates. Will the fixed rates move in line with that in advance?
Look, fixed rates will probably more follow the bond rate. So look, you've actually seen a little bit of higher pressure on fixed rates because in the US, bond rates have been going up ahead of the Fed's decision in 2 weeks. So our Australian bond rates have tended up a little bit. So they will tend to much more closely track the bond markets. They're much more synced, Australian bond rates with US bonds. Not totally, but will tend to follow the US. So you've probably also, I think, maybe have seen a bottoming in fixed rates, but that doesn't mean the variable rate's going to go up. In fact, we could still see another cut in February, March next year if the RBA follows suit. So I'm sitting on the fence on this one. Okay. I like it for certainty, but I don't see any urgency to. I don't think the variable rate's going higher in the short term.
Good advice. If you need a home loan, don't forget switzerhomeloans.com.au. Good fixed rates, good variable rates. Check it out. That's all we've got time for. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money.